Throw it over to Alex Morsink, Managing Director of Equivesto. How you doing, Alex?
I'm doing great, Craig. Thank you very much for having me. It's always fun to come and hang out with you and chat about all kinds of interesting topics. Today, we're covering jumpstarting your VC round with equity crowdfunding. So I'm going to talk about a few different things relating to that. I'm going to start with just an outline of some of the core facts about angel, VC, and equity crowdfunding raises. Then I'll talk about the differences between equity crowdfunding and a venture capital raise, and then the benefits that you can get from combining them and doing them in tandem or kind of one after the other. And again, please put your questions, comments in the chat Q&A window, and we'll try to get to all of them. So let's just talk about some of the real key facts about raising from equity crowdfunding versus venture capital fund. So with equity crowdfunding, the minimum amount you can raise is $25,000. With a VC raise, typically the smallest you would go and raise is around $500,000. With equity crowdfunding, in Canada currently, with the new rules starting next week, the maximum that you can raise from equity crowdfunding is 1.5 million. With a VC sort of Series A, you're probably going to be getting at most between $2 and $5 million Canadian. The minimum stage, so the earliest that you could go to raise from equity crowdfunding or from venture capital, from equity crowdfunding is typically around a seed round. Pre-seed would probably be, from family and friends when you're getting the capital to create the needed minimum viable product. Once you have your minimum viable product, then you're eligible for equity crowdfunding. With venture capital, typically it's Series A where VC funds get involved. There are some seed round venture funds, but typically venture capital does get involved a little bit later on in the round. And what industries can raise from both of these two methods? VC funds typically are specific themselves. So one VC fund will specialize in one industry and one will specialize in another. So make sure to do your research with VC funds to figure out which fund matches your industry. Equity crowdfunding can support all industries, but industries that have a strong community customer focus, general public focus often do much better. So let's talk about the timeline and some of the differences between equity crowdfunding and raising through venture capital. So with equity crowdfunding, the application process takes about 1 week. Due diligence takes about 2 weeks. There's no negotiations because we're working with you to support your raise. Campaign prep usually takes, we recommend 1 to 2 months, going over campaign structuring, planning out the marketing, doing pre-campaign marketing, all of that. Campaigns can legally run a maximum of 3 months, but we recommend campaign length of 45 days. Closing takes about 2 to 3 weeks. And so the total sort of maximum recommended time is around 6 months. With venture capital, the application process usually takes about 1 to 4 weeks to sort of send, cold email in or send, fill out their application form, get a response. If they're interested, they'll initiate due diligence. That often takes between 2 to 4 months, usually a little bit shorter around the 2-month mark, but you never know. And then you enter the negotiation period. So that can take another 2 months going back and forth with your lawyers and their lawyers to determine, what changes are necessary to your shareholders agreement, going over the valuation, pricing, all that sort of stuff. And then closing itself can take 1 to 3 weeks. So typically for a VC round, you're looking for sort of 6 to 9 months from getting introduced to the VC fund to closing and actually getting the funds in your account. So let's talk about what you actually need to access each of these funding types. So essentially for both equity crowdfunding and venture capital, you're going to need articles of incorporation, cap table, organizational chart, a pitch deck. You'll need financial projections, a shareholders agreement, and details of how much you're raising and why you're raising it. For both equity crowdfunding and venture capital, financial statements and a business plan are nice to have, but not a need to have in every scenario. So speak to the platform or the VC fund to sort of see what they're looking for. But the core documents that you need are the same for each of them. So let's talk about some of the benefits that you gain from each of the two different funding methods and some of the drawbacks to sort of set the stage about how they can work well together. So with equity crowdfunding, one of the benefits is that control remains with the founders. Typically, people are issuing non-voting common shares. And so you, as the founding shareholders, keep all of the voting shares and 100% of the voting control of your business. Valuation and structuring is a joint decision. So with equity crowdfunding, you're working with a platform like Equivesto to determine the optimal valuation and structuring for your round that'll result in your success. Comparing that to a VC situation, an equity crowdfunding platform is going to give you feedback around your valuation, but getting your valuation lower and lower doesn't benefit us in the same way it would with a VC round, where the lower your valuation, the more control and more sort of bang for the buck the VC firm is getting. So with the equity crowdfunding platform, we're helping you, and making sure you get real value for the work you've put in so far, but understand the drawbacks of being overvalued very soon in your capital raising life cycle. There's also a potentially faster time to funding. Depending on how long the due diligence and the meetings can take with the VCs, that can really stretch out. If you are thinking about the amount of time I've been encouraging people to prepare for a crowdfunding campaign, it can feel a little bit like the opposite. A VC firm, you have a couple of meetings, they say yes, boom, there's a check in the mail. Now you've got your millions of dollars. Equity crowdfunding, I'm asking to book months of meetings and preparation before the campaign, and then you do the campaign, and then there's the closing after that. It can feel like it takes much longer, but in reality, all we've done is flip the order of the work, and we've made it clear up front the order of the work involved. With the VC round, as soon as you get that term sheet, you feel like it's locked in, I've got the money. That's when the due diligence starts. And then there's still negotiation after the due diligence if, something has changed and all these things. And so that's what can really drag on. And that's kind of hidden in the back end. You're not as aware of that. So if you're worried about the cash flow position of your business, you get a term sheet from a VC, you're like, great, I'm saved. I'm going to get the money in a month. It's going to be fantastic. It can actually take a further 5 months from getting that term sheet. With equity crowdfunding, we want to do that planning in advance. So when you do launch the campaign, it is a success. It's not a race to get the campaign up. It's really putting in the time and the effort to make sure that when you launch the campaign, it's going to be open, get funded really quickly, and close quickly. That's kind of the goal of a successfully planned crowdfunding campaign. Another benefit of equity crowdfunding is community involvement. You're getting your extended network of hundreds of people, potential customers, suppliers, extended friends, all those people on LinkedIn who you forgot that you had on LinkedIn, but you still have on LinkedIn and Facebook. They can all see and participate in your round, and you can really get your community that supports your business even further invested and change them just from stakeholders in your business to shareholders in your business. That community involvement can translate into ongoing support from those same individuals. Now that they've been activated as investors in your company, they'll be in a much better position to go out and be evangelists for your product or for your business and what you're doing in the future. Providing updates, every quarter to them can come with an ask, and you can sort of use these hundreds of part-time salespeople essentially to help grow your business. One other benefit of ECF is that it's not just a purely financial investment play. With equity crowdfunding, because the minimum investments are low enough, people can come in and support your business because of the actual acts that your business is doing, the change that it's making, the impact it's having, rather than just coming in purely for potential return. Of course, people can invest and will invest for the potential return in your business. This is not a donation situation, but you're also able to leverage that positive impact that your business is creating to get more people excited and interested in supporting what you're doing. And another key benefit of equity crowdfunding is it's not just for startups. When we talk about VCs in a moment, typically VCs are one way for startups and businesses to raise capital, but VCs are looking for a very specific type of startup that's going to grow in a certain way, hit certain metrics, and then allow for an exit also in a certain amount of time. Many small businesses don't fit into this kind of space. And so equity crowdfunding can be a great option to raise capital for businesses that don't perfectly fit that VC model. But there are definitely some drawbacks. So some of the drawbacks are that you have to manage many investors. You have to be hard at work throughout the duration of the campaign and the preparation to make sure that the campaign is successful. Critical to that is the marketing effort and even preparing and having an adequate marketing budget. Putting dollars into the marketing for your campaign is a key differentiator between success and failure. Another drawback potentially is that you're not necessarily getting a big name investor or VC firm who's coming onto your board and going to add tons of additional industry expertise and sort of helping lead and grow your business. There's no guarantee of a successful campaign, and regulation limits the maximum amount that investors can put into your deal and limits the location from which you can get investors. Let's talk about VCs now for a second. So counter to some of the drawbacks of ECF, VCs bring with them management support and advice, strong potential connections, and there's fewer actual individuals on your cap table. So that's a little bit easier to manage. Also, VCs can participate from any location, though typically VCs will sometimes target areas that they operate in. There's a lot of bigger name VCs from the US that actively participate in Canada and internationally. And so you can get US VCs, European VCs participating in your round. What are some of the drawbacks, though, of raising from VCs? You're losing some of the control of your business. Typically, VCs are going to come in expecting at least a board seat. They'll have voting rights, potentially even veto rights over decisions you're making. They're going to want liquidity preferences when it comes to the exit, and they'll want structuring preferential treatment as well. Your valuation is now a zero-sum game. So you want the highest valuation as possible to demonstrate, what you've created in your business. The VC, the lower they can get your valuation, the more ownership that they get over your business. And at the same time, the higher return that they'll get at the end when they do exit. You do have that long period of due diligence and everything that you go through with a VC that can delay getting the capital. And there's also a large legal bill. This is something that, if you haven't raised from VCs before, you might not be aware of, but all those negotiations and decisions around modifying the cap table and everything like that, and modifying the shareholders agreement, that comes with large legal costs, both from the VC's lawyers and your own. When investments go forward and you do get funded, you are actually saddled with the legal bill of your VC's lawyers, and you don't get extra capital from the VC in order to offset that. So if you spent $20,000 on legal fees during this, and the VC spent $20,000 on legal fees during this, and you're only raising $200,000, $40,000 of that raise is going to the legal fees that you just incurred. What's important to remember also about VCs, and I'm not railing against VCs, I just want to make sure we can outline some of the details of the two different funding types. This whole presentation is about how they can work together effectively. But with VCs, what's important to keep in mind is VCs are operating with some of their own money, but mostly other people's money. Fund managers and people running VCs have been hired by their limited partners to invest in deals that are going to make them strong return within a certain time frame. They are beholden to their investors, just like you will be beholden to your investors, including the VC. VC funds operate under the model of investing in a select number of companies that all have really high potential in a short period of time, usually 3 to 7 years, and pushing for a 10x return in that 3 to 7 year period. With 8 out of the 10 companies failing, 2 of them being successful at the scale and size enough for the VC to make the return that they need. And so sometimes VCs can become very focused on meeting those milestones that they've promised to their limited partners. Certainly when it comes to hitting critical metrics for future rounds, and also having an exit opportunity. So they're looking for specific companies that will be able to achieve that. And once they invest, this is the beginning of a long-term relationship with the VC. So they'll be looking for ways to make sure that you stick to those milestones that you promised them when you initially raised the capital. So now that we're sort of all on the same page regarding the similarities and differences between equity crowdfunding, venture capital, and how they can sort of work together, let's talk about specifically how you could run a round using both of them, because they don't need to be against each other. They can be used together in a harmonious way to really drive even further success for your campaign. Essentially, you would use the ECF campaign, as the subject of this whole presentation explains, to jumpstart your VC round. You would do an equity crowdfunding campaign before the VC round to build interest, to build hype, to build excitement, and to get some initial capital in the door, which will then demonstrate traction to the VCs, get them interested, and hopefully get them coming in at larger amounts or feeling more comfortable about investing in your business. Essentially, what you would do is you would prepare and hopefully, over several months, prepare a very strong equity crowdfunding campaign. You would then launch your equity crowdfunding campaign and be running that campaign actively. And at that point, that's when you would start going out to begin pitching VCs. As you're pitching the VCs and your round is getting, 80%, 90%, 100%, and now you're 150% funded, 200% funded, that's when, the EC round then comes to the close. The VC firms are interested and excited, and then you go and close the VC round after that. You're discussing with the VC during the campaign, but you're often finalizing the VC investment after the equity crowdfunding campaign has closed. And you're really making use of all of the preparation that you're doing for equity crowdfunding to also help prepare you for a VC round. And what are some of the benefits that you get from running around in this way? The first one is a clear demonstration of traction. So running an equity crowdfunding round successfully clearly indicates the interest and the excitement from your extended company community and your ability to raise capital before you've gone out and spoken to the VC. So essentially, you're proving your ability to effectively get interest, get excitement, to market yourself and to build, the success and ramping up of your business to the VC in real time. You're continuing to build excitement and interest in your investment opportunity from investors of all sizes through this campaign leading up to a VC round. And the VCs can see capital going into your business already. They can see that there's interest. They can see that they're not alone. One thing that angels will often ask if you go pitch to an angel syndicate is, have you pitched to any other syndicates? Is anyone else interested? Everybody else wants to know if other people are involved and if there's some excitement and, you're getting, this venture firm is coming in. Oh, I want to come in now. There's a little bit of that going on sometimes, certainly in smaller startup communities. And so having a crowdfunding round like this, you can say, yep, we've already raised $500,000 or $200,000 or $700,000 through our equity crowdfunding campaign. That, from the perspective of the VC, shows that you're serious and shows that you're capable of raising serious money already. So that can help demonstrate that to them. The next is valuation. So a successful ECF round demonstrates investor interest at the set valuation. If you're concerned about the VC really trying to push your valuation lower when you go to speak to them, if you've gone out and raised on a valuation through an equity crowdfunding round, Amal cannot hear. Can everyone still hear me?
Yeah, we can hear you fine.
Okay, great. So you can use this and all the work that's done with the platform to set that strong valuation. Craig, I'll let you deal with them all there in the chat. difference between going straight to the VC for the valuation and coming through equity crowdfunding first is that you're able to leverage the time and effort that the platform and the team will put in with you to strengthen your valuation, to have to work on your financial projections, to make them stronger, to get them prepared so that when you do come forward with evaluation, you have even more things that can sort of start and provide proof and strength for that valuation to the VC. Also, it provides a starting point of proof for those valuation discussions. Typically, if you're going in, all you have is your previous raise, which was potentially a year or more ago. And so the VC can kind of decide themselves based on what you've done so far since then, how much they feel like they want to, set the valuation. And it's really a firm discussion and negotiation between the two of you. If you've just come off a successful equity crowdfunding round and demonstrated investor buy-in from 100 people, and potentially some angels as well, it sets a starting point. You're not necessarily going to get that valuation. You might have to sort of negotiate with them around things, but it sets a benchmark starting point, which is very valuable. The next piece, which is very critical and a benefit of running them in tandem, is investor readiness. Running an equity crowdfunding campaign requires a lot of detailed preparation and work to be done in the run-up on the structuring side, on the finance side, on the legal side, and on the marketing side. And if you were to pay for these services directly from someone else, that would cost tens of thousands, if not hundreds of thousands of dollars. You can apply to an accelerator who can give you, those things, but typically accelerators take some equity from your business as sort of payment from the services that they're providing. Essentially, because you're raising a round and a piece of that round is the payment to the platform, you could benefit from all the work and the time and the effort that the platform puts into helping you get ready prior to the campaign and leverage that to then use in your venture capital round. Platforms typically, including Equivesto, we give hands-on and in-depth feedback on your pitch deck, business plan, financial projections, your communication and flow, your shareholders agreement and legal documentation, and the structuring of your round. We provide full consulting on all of these things. We work back and forth with you on all of it to sort of perfect and prepare your campaign for a round. You work typically with a marketing firm who are experts in marketing your campaign and setting yourself up properly to pitch and present yourself to interested investors. All of this is essentially like going through a mini accelerator program, and that's a lot of value that you get that helps you in advance of a VC round. The next benefit is actually one that the VC experiences, which is reduced risk. So from an investment perspective, the more capital invested in a business, the less likelihood of the company failing due to lack of available capital. The number one reason businesses fail is actually that there's not enough access to capital. And so if a business, let's talk about an example. So if a business needs $4 million to achieve their milestones and sort of get to the next step, and they've already raised $1 million from equity crowdfunding, all that's needed from the venture capital firm to get to that desired success level is $3 million instead of the full $4 million that they would typically provide. This allows the VC to invest in a company that's going to win. It's going to hit those goals and reach what they need to have that successful target, but they have to provide less capital up front to make that successful. So they are less exposed as an overall percentage of their VC fund to this one investment. They're able to use that capital somewhere else and further diversify, but the company is still getting the capital that it needs to succeed. So that really helps the VC fund reduce their risk and exposure to this one investment. Also, typically ECF, equity crowdfunding campaigns, offer non-voting shares to the investors who are participating. So the venture capital firm doesn't need to worry about any challenges regarding control or management of the business. They will still have, their voting rights and potentially, a board seat and a veto or whatever, but they're not, they're getting that additional $1 million in, but they're not needing to worry about another investor coming in and demanding a certain control or rights that might try to fight with the VC. These investors are coming on essentially as silent partners that you provide quarterly updates to. Also, an ECF campaign can act as a litmus test for the company. A successful campaign can indicate to the VC that there's widespread interest in the company's mission and in them as an investment opportunity. Equivesto itself has had conversations with different VC firms who have shown interest in actually taking companies that they want to work with but aren't yet ready and having them run an equity crowdfunding round with a platform first so that the company can get this expertise, get this support, and raise some initial capital to help them get to the stage where the VC would then be ready. So that's something that VCs are already thinking about leveraging in the space to help companies grow and scale. And this is an area where there's a lot of potential for VCs to benefit. Community support. Most raises in Series A and beyond include marketing and the use of funds. You've created your product, you have your minimum viable product, you're raising capital to then go out and market your business to try to get more sales and grow. An ECF round includes a detailed and targeted marketing campaign to drive the success, with potential investors often being the same kind of individuals as potential future customers or community members. So an ECF marketing campaign introduces your company to the broader market and is building excitement about your product. So you're actually getting a double benefit. One, you're marketing for your investment campaign, trying to get investors to participate, but at the same time, you're also marketing your product, your services, and all this sort of stuff. And so if you're thinking about, okay, I've raised from my Series A, I've got my $1 million, I'm going to go and run a marketing campaign right now. That will usually be an internal marketing effort. You'll probably have a couple board members with experience in marketing, and you'll build an internal marketing campaign to go out and do that. If you've run an ECF campaign already, you've worked with marketing specialists and marketing firms that understand this space and how to go out and run a successful campaign. You're getting hands-on education from these individuals around how to run a campaign properly, but also, given your campaign was successful, you have learned exactly what techniques you need from this campaign to target the individuals who will be your future customers. You already know exactly the types of ad sets that you need to use to reach them. Okay, they prefer LinkedIn versus Google. All of that prep and training work has been done by marketing professionals already as part of your campaign, which you can then just leverage and continue on your own after your campaign. It's also strengthened your community engagement and the amount that the community is interested in participating in your business. If you're going out to run a crowdfunding campaign, it's important that you're active on social media and you are posting frequently and you sort of get in the habit of some of those things, having a newsletter, sending updates that you might not have got into the habit of doing before. Having an active outward communication plan to the general public, to your followers, to the people on your newsletter really helps build that community around your business and turns it from, something that you've been quietly working on the side into an idea that many people in the extended community where you live are all engaged in. And then finally, a successful campaign results in dozens or hundreds of these smaller investors who, as I mentioned already, can become vocal supporters for your business. You can leverage them if you're launching a new product or something a year later. In your newsletter to your investors, you can mention that the new product, you can say, hey, does anyone know somebody looking for X, Y, and Z? You have all these people out there that care about your business and are willing to go out and evangelize for you. And that's something that money can't exactly buy. It's this engagement and support from these individuals. So let's talk about two examples. So this has been done frequently in the US and the UK, but two examples that I can speak to personally because they both raised through Equivesto are Hutsy Financial and Award Pool. So Hutsy Financial successfully raised on Equivesto earlier this year. And during the campaign, they already began discussions with a US VC firm. The US VC firm saw the campaign, saw the interest, saw the engagement, wanted to talk to them more. And they went on during the campaign to get a term sheet from the US VC. And they're basically, it's been several months, but they're almost finished the closing of that investment period. And so that demonstrates the length of time it takes sometimes for VC investment. But in this scenario, it resulted in an immediate increase in value and return for the crowdfunding investors. The valuation of Hudson Financial during the crowdfunding tripled when they got the valuation from the venture capital firm that they raised with and got the term sheet from essentially 2.5 months later. And so for people who participated in the crowdfunding round before, their initial community of supporters, they got an immediate benefit from that increase in growth. The VC firm saw the interest, saw the traction, and they did raise the money successfully in both locations to go out and continue their journey. The other example, Award Pool, similar type situation. Their equity crowdfunding round with Equivesto was part of their broader Series A round. So they used the equity crowdfunding campaign to invite their community to come in and support them. And of course, that round was successful, but it was also included as part of their broader Series A, which included large institutional investors and corporations that operate in the same space as them. So the round helped bring awareness, visibility, and demonstrate traction so that these other investor groups became excited and decided to participate further. So those are some examples from Canada. Again, in the United States and the UK, where equity crowdfunding has been around longer, this has been done dozens, if not hundreds of times, but I wanted to give 2 Canadian examples as well. Thank you very much for listening to the presentation. If you're interested in learning more, you can head to equivesto.com/learn. That's our learning center, which has detailed information from both the investor perspective and the issuer perspective. You can also reach out to me directly, alexander.morsink@equivesto.com, or check us out on all social medias at Equivesto. Thank you.
That was great, Alex. Thanks. We do have some questions.
Perfect.
And hopefully some more coming in. But I have, oh, good. There's a couple more coming in. Great. This is a common one, so I want to address it a couple of ways. But the statement here is VCs are not willing to invest in a company who receives equity from crowdfunding earlier. So what will happen if we start crowdfunding and then VCs stop thinking on investing in our business? So people are concerned about, I've heard this before, messy cap table, or, VCs won't be interested in me if I do equity crowdfunding. What's your response to that?
Yeah, it's a good question. Equity crowdfunding in Canada is relatively new. And so, if you introduce something new to an environment, people are going to be a little bit concerned. They're going to wait a little bit. They'll want to see sort of how things work before they get more involved. And so if you think about, a VC's reaction, they're saying, okay, I don't really know how this all works. I'm concerned because they've never experienced it themselves. If we look at a more mature market like the US or the UK, where, VC firms have been, equity crowdfunding has been around for much longer, and VC firms have engaged in and invested in companies that have done equity crowdfunding, we can see that both VC and equity crowdfunding campaigns play very well together. In Canada, yes, there is the idea that, okay, a VC would be concerned about investing and they don't want to participate, after a company has done an equity crowdfunding round. I would ask if you have any specific examples of the VCs in Canada. I know initially when things were just starting out, there were a lot of VCs that were concerned and weren't as interested, but as time has progressed, more and more VCs have gotten comfortable with it. I know of many VCs that I have spoken to personally about this that are totally comfortable with it and would be interested in investing in companies that have done equity crowdfunding. Talking specifically about the cap table question for a second, with equity crowdfunding, if you're doing a non-voting share, typically you will create a new share class for those non-voting shares. And so on your cap table, that new share class can be represented as a single line item. You can include all the other minority investors on another tab of the document or something, but visually from the control perspective, there is essentially one share class of non-voting shares, which represents essentially one singular group. Companies will also sometimes include a voting trust for the non-voting shareholders, which is controlled by the founder and CEO of the startup in the investment agreement. And so in that situation, even though the shares are non-voting, if there was voting rights prescribed to the non-voting class as a whole, those rights would be controlled via the voting trust by the founder. So when the VC would look at the cap table, there would be the founder, the co-founder, a couple other people, maybe some angel investors, and then the VC themselves, and then just a non-voting share class, with 15% of the business or something at the time. And typically that has worked well for companies raising in Canada, and other structures have been used in the US as well. Hopefully that answers your question.
I think it does. I want to answer this next question. Well, it's will those investors eventually become shareholders of your company? And I think you answered that, but
yeah, I'll just talk about that directly. Yeah, so if somebody's investing in your business, an investment means they are buying shares of your company. So if somebody's investing, they are a shareholder. That's the transaction that's taking place. And so that is implicit and required as part of an investment like that. So the answer is yes.
And like you mentioned, just in case, depending on what their concern was the question is, the cap table can be cleaned up pretty good.
Yeah. And I just want to address one more thing, Craig. I realized that potentially, the person heard crowdfunding, and so they're thinking about, are people coming in from, a different type of crowdfunding? Are they becoming investors in the business? So I just want to clarify, we're not talking about doing a reward-based crowdfunding like something you do on Kickstarter or something like that. We're talking about specifically equity crowdfunding, which is literally offering shares for purchase to the general public as an investment opportunity, as opposed to, offering a pre-order of a product or some perks or something like that. So this is about offering shares of your business for purchase to the general public prior to then going to do a venture capital round. If you were to do a regular crowdfunding round, not an equity crowdfunding round, but a regular Kickstarter round, those people are not investors in your business.
Good point. Thank you. I wanted to talk about small checks for a bit, because it seems like there's some confusion around, and it's not necessarily equity crowdfunding, but an investor confusion. When I talk to startups, everyone, I'm looking for $2 million. I'm looking for $5 million. They're looking for that one investor to write that one check. And rarely does that happen. Most of the time, right. I just did an interview and we were talking about this with Mark, the founder, one of the co-founders of Oxio, and they just finished raising 50 million or something. And we talked about this. You got to start with the small checks first, right. Because people need to see there's other interest. They need to see other investors, other people. There's interest. You can sell, you can pitch, you can do these things. And I consider equity crowdfunding just another one of those investors that generate interest. And every investor I talk to, you've been on a few of the panels where we've had VCs and angels in, and they've all indicated that they respond to equity crowdfunding very well, that right. It's a positive sign, not a negative sign.
Right. I agree for sure. One thing that's also a little bit challenging, and that it's a conversation I have frequently with founders, when you enter the crowdfunding space, when you enter the startup space, you're trying to gather information about what things are going to be like, how you should expect things will go. You're a first-time founder, you're trying to get a bit of a lay of the land. And a website that provides a lot of information about what's going on with startups is Crunchbase. And so people will say, okay, I don't really know what's going on. Crunchbase has this newsletter. Crunchbase is always posting. I'm going to just subscribe to this so I can see what's going on. And people miss out on the critical piece of information that Crunchbase is focusing on, honestly, US startups, specifically, action that's taking place in Silicon Valley. And the startup community is actually different in every country. There's different rules around how you can raise capital, and there's different investor interest in every country. Investors, VCs in Canada operate quite differently than the way VCs operate in the US and especially Silicon Valley. And so if you're looking for what is a seed round, what is a Series A round? And your definitions are being provided by accelerators in Silicon Valley, like Y Combinator, or they're being provided by VC firms in Silicon Valley or Crunchbase or something like that. That's not actually teaching you about what the Canadian space is going to be like. Canadian investors, including venture capital funds, come in at later stages for smaller money. What would be considered a seed round in the United States is a Series A round in Canada. And so when you're entering the space, if what you're getting is the daily email from Crunchbase that says X company completed a Series A for $50 million and 5 million came from this guy and 10 million came from this guy, you start feeling like, wow, I'm doing something wrong by not getting these massive checks. And you feel like you should be able to grab 5 million from this guy and 10 million from this guy quite easily. But there's a real survivorship bias where only the best, most successful companies are talked about. And the US space is a lot more cash flush. They're investing a lot more money in larger amounts sooner. And so in Canada, that's not really a fair comparison for a company trying to raise from Canadian VCs. Typically VCs are writing checks in the hundreds of thousands. Getting a check from a VC, an individual VC of $4 million would be massive. It would be a very large check to get. Typically, you're going to be getting 500,000, 1 million, 1.5 million. They usually deal with much smaller check sizes, and then a bunch of different VCs will all participate together. So the idea that I want to raise 5 million, I'm going to find one person to write me one check for 5 million. If you can find that one person, that's fantastic. But don't plan your campaign, your raise around the fact that you will find that one person. You want to be able to break it up into sort of more consumable bite-sized pieces for a variety of different players. And one of those could be equity crowdfunding.
Yeah, most investors don't want to take all the risk. They want to share the risk with other people.
Right.
We've got a few more questions here, but I'm going to start with equity crowdfunding support. Equity crowdfunding support a startup, a self-employed person without shareholders or employees? So what's the minimum there?
So if you have a business that's operating and has already, you already have a minimum viable product, or you are operating and everything, even if you don't have any employees, you can use equity crowdfunding. Something that's really important to note, though, is that equity crowdfunding, one, is a lot of work and takes a lot of time and effort to sort of do a campaign properly and successfully. And so sometimes for a solo entrepreneur, it can be a lot of work to put on in addition to operating the business. But also you want to make sure that your business is at the stage where you're ready to sort of scale in that kind of way. And you've generated potentially enough returns to afford the marketing costs of doing a successful equity crowdfunding campaign. But we don't have a minimum employee count or a minimum previous investor count to run an equity crowdfunding campaign.
So I got another question here.
Mm-hmm.
How does crowdfunding evaluate a company? So how does Equivesto or the crowdfunding platform value a company?
Yeah. So you're asking about the valuation, or you're asking about our due diligence process?
I think it's you're talking about the valuation that determines the share price.
Sure. So we've spent a lot of time gaining expertise around how to do valuations for businesses. We've given presentations to you, Craig, to CPA Ontario. We've been on panels about how to value startups. Valuating startups that are early stage is a real challenge. If you're talking about a company that has barely started operating or barely has any traction, it's impossible to give a fair valuation for the business based off what is currently happening in the business, which is what you would do for a typical existing business, right? If you were going to buy a restaurant or a shop, you'd look at, okay, what are the existing sales like? Maybe, I'll consider, 2 or 3 times revenue multiple. And that's kind of the value for an existing business. With a startup, you're looking at the potential for the business in the future. And so you are trying to find ways to look at, okay, what is the potential for this business if everything goes well? What is the potential for this business if it goes bad? What is the strength of the team? How likely are they able to deliver on these kind of promises? How much thought and effort have they put into sort of preparing themselves for this? What are they like as leaders? How do they work together? All those things come together to create the valuation. We operate a little bit differently in that we are not here as arbiters saying we will only allow somebody on the platform if we as a team would choose to invest in them. That's not how we work. We're about creating access and opportunity for all founders, including founders that have tried to go the VC route and haven't found success. So we're not trying to say, I need to personally choose that I would invest in you for you to come and raise on the platform. But where we really put in our time and effort is to make sure that we can understand the strength of your business and your team and their ability to go and deliver on, the goals that you're setting and the potential for the business that you've outlined. But we also want to look at the value that you've built before. It's a rather complex process, but it's something that I'd be happy to talk about in detail. I know that we did a webinar on this, so I'm sure on Craig's YouTube channel or even on Equivesto's, there's a video where I talk about how to value early stage startups. But essentially, it's based on the strength of the team, the potential that you've outlined for the business in your projections, and also the detail, the level of thought, time, and effort that you've put into really mapping out how you're going to achieve that success and why, you have planned this out the right way and that you've thought of every sort of possible scenario to get you to that success.
Yeah, email me and I'll send you the links to those videos where we've done them in the past.
One last word. Sorry,
Yep.
Craig. One last word on that. The final decision of the value of any company, of course, always rests with the founder. We are going to provide our feedback and our advice because we want to help and we want to give you the best advice that we can. The final decision of what your company is valued at always remains with you as the founder, as the management team of the company. We cannot choose the value in that way, but we can give you the best sort of constructive advice and support around what we think would be optimal for your business.
So this is the next question here. As I understood, Equivesto will be one of the future investors after raising equity round, after their equity round is finished. How much is Equivesto's share portion besides the other investors? I'm not sure how this.
Yeah, so Equivesto is not one of the future investors in the business. Equivesto is the broker. We're the third party that's doing all of the due diligence and protection to make sure people are able to invest properly. If we were investing ourselves, that would be something we would need to very clearly disclose because there would be potential for a conflict of interest in that situation. So Equivesto itself as a platform, we do not invest in the deals themselves. It's the investors who are coming in who are investing in the deal. And so the percent that they're taking depends on the price per share, the number of investors who participate, the valuation of the business, all those things that are discussed in terms of the structuring process. Equivesto takes a fee to sort of provide this service, and our fees are outlined on our website. We have an application fee of $2,500 upfront, and then we take 7% of the total raise amount as our payment, not in equity, but just as the dollar amount. We take that as the payment for our services.
So I'm going to put, I'm sure we have people who have more questions. If you have more questions and want to book a one-on-one meeting, I'm going to put the link in the chat room. I already did it, but I'm going to put it again. You can book a meeting, 30 minutes with Alex this Friday. So feel free to do that. I wanted to ask one more thing, and if there's more questions that come in, can you talk a little bit about cross-province investing and the new rules?
Yeah, certainly. So there's some new equity crowdfunding rules that are coming out essentially in 1 week, which is very exciting. We've already done a video about the new rules and some of the changes there. One of the critical changes to these rules is, there's been different rules in each province for equity crowdfunding for some time. Equity crowdfunding involves purchasing shares of companies, which shares are a type of security, and all securities, both private and public, are regulated in Canada by the Canadian securities regulators. And unlike the United States, where there is one securities regulator called the SEC, in Canada, there's a different securities regulator for every province. What that means is when equity crowdfunding was initially created, the rules around what was allowed for equity crowdfunding was different in every single province. When a company goes out to raise money, the rules they have to follow are not the rules where they reside. The rules they have to follow are where the investor resides. What that means is if a company was trying to raise from multiple different provinces, they would need to meet the equity crowdfunding rules for all of those provinces at once, which was rather challenging. The exciting thing about these new rules is all 8 provinces in Canada that currently allow equity crowdfunding have come together and finally agreed on a unanimous set of rules. So the same rules apply in all 8 of the provinces, which means that it's now so much easier for companies to raise in all of those locations all at once, and from an investor to participate from any of those provinces in any crowdfunding deal. So that's very exciting. We were proud to be able to participate and give feedback to the regulators around the creation of those rules, along with our competitors, to really make this change and help move this change forward. And we're very excited that that's coming in next week.
And I know it's on the screen, but if people want to contact you or find out more about equity crowdfunding, where do they go?
They can head to equivesto.com, equivesto.com. We have a learning center there. You can also follow us on all social channels at Equivesto, or you can reach out to me directly. Also, check us out. We're on the TorontoStarts website. I think as a community partner. And so there's always more places for people to find us. You can just Google us as well.
Absolutely. Thank you for taking the time and answering everyone's questions today. I'll email out the recording and the links and where you can book a one-on-one meeting with Alex tomorrow morning. Thank you, everyone. I appreciate you taking the time today. And thank you, Alex, for sharing all your knowledge.
Thank you, Craig. Okay, bye.
Bye.